it becomes a learning point to the economy, learning point to the financial market, some area that they overlooked. So that gives us the room to develop a new regulation. Okay, so that's how from Basel 2 we came to Basel 3. Okay, so though that is also a learning point to us. So crises, indirectly even, they help us to ensure that the market is always updated and secure. Okay, and at the very last, we will cover the specific financial market development. So if you take your past papers, you know definitely there is a question on what's happening in the US, UK, and the major economies in the world. So there we will cover the financial market developments that has happened in the last 6 months on a more summary, and the reasons behind that. So that is the subject overview. Okay, so with that we will get into our first chapter. I hope I'm audible enough. Okay. So our first, as I mentioned to you, we are going to look at the introduction into the financial market and financial systems and financial markets. So you all should be having a slide with the PowerPoint slides, which is a more summary version of it, and the more detailed and elaborate note. Okay, so have both open if it's possible for you, or if you're looking through the mobile, just listen attentively on what I'm explaining. Especially in this particular subject, I want to emphasize, in this subject, especially when you're writing for the exam, you have to be exam focused as well. Okay, so and when you focus on your exams, you don't have to memorize and paste it in your exam answer sheets, but ensure you write the essential keywords. When we go throughout all these chapters, I will tell you certain key terms are non-negotiable. You can't change it. Okay, so I know you don't have to memorize the entire paragraph or a definition, but know the keyword and use it correctly and have a good understanding. I know you can't just memorize it and get a good understanding. Always I'll try to link it to a practical world example so you're aware about, or you can relate to the practical scenario. Okay, so before we start off with financial market, our focus is financial market, but remember, for financial market to work, it can't work alone. Okay, so this financial market is a component of a more broader framework or more broader network. So this broader network, you simply call it as financial system. Okay, financial system, understand it simply as a method for funds to move from surplus units to the deficit unit. Why do you need the financial system, or what does the financial system basically do? To ensure that the financial intermediation from the surplus unit to the deficit unit, the funds are moved efficiently and effectively. It can be direct movement or it can be indirectly, but financial system's main function is to ensure that this channeling of funds happens. Okay, so this is a diagram that explains the entire financial system in one shot. Okay, so let me elaborate on what's happening. So first, you have the savers. For now, forget the word lender, focus on the word savers. Okay, so you and I, we do a job, we get a salary. I hope you don't spend 100% of your salary. We at least save, let's say 20 to 30% we save. Okay, so we have some money left in our bank that we save on a monthly basis. That's on a household basis. Okay, so businesses also do the same. all their entire profit they don't waste. They ensure that they keep something for the next year for their future investment. So some sort of a saving happens from each 4%. Household, business firms, even a government when they have a budget surplus. So that gets carried on. That's what they're having. It's a saving for them. They hadn't spent entire income on their expenses. They've had something to save for some emergency. Okay. So even foreigners, so that's where the forex inflow comes in. So we are the savers. All right. So but as a saver, we have money. We have excess money. When I say excess, we have an income. We have met our expenses. And even after settling our expenses, we have some excess funds. On the other hand, you have certain spenders. Now, who are the spenders? They do get an income, but their expenses had been higher. They've made some investments, some capital related investments. So their expenses had been higher. Okay, so the income is short, expense is higher. Now they are at a deficit unit. They don't have money with them and they need more money to meet their additional expenses. Mostly in this category, you can see mostly it's the business firm which comes on top. Why? As a business firm, you need to make some changes. You can't just run with the same level. Why? Your competition has been increasing. You need to put up a new plant. Demand is increasing. Okay, so there can be certain aspects. So even currently, even a COVID affected economy, there can be a deficit unit. Why? When it comes to companies, maybe not on a capital intensive on a production basis, but to set up a more safer environment. So to do something like that, they might need some additional funds. And even especially government. So, you know, the government has been supporting very well with all these COVID measures. And for them to meet that additional expenses, they might need some extra money. Then you have some households who might need to buy a car, need to buy a house, who need certain funding. And also certain foreigners who want to borrow and maybe invest locally or for their own purposes. Okay, so you have the spenders who need the money. You have savers who have excess money. So how are we going to link these two? How are we going to ensure that the excess fund from the excess unit moves to the deficit fund? So this channeling is what is done by the financial system. Simply, that's what happens. Okay. Now, when you take a entire larger scale market, for this to happen, you need to be aware that it doesn't just happen. Okay, you can't just take money from the excess unit and give it to the deficit unit. There should be some mechanism, because the excess unit might not know that there is a deficit unit available. There's someone who needs money here, the other savers might not know. Okay, or sometimes savers might be scared to directly lend to that person because they don't know whether they will use it to the correct purpose, whether they will give the money back. Okay, so the way to connect these two people, these two parties, have been very challenging. Okay, so one of the earliest method is you get the funds from the savers, and for you to route it to the spenders, one of the ancient method that has come is there is an intermediary in between. Okay, so you have a financial intermediary in between who will accept deposits and then lend it to the deficit unit. So that itself might get an example in your hand, your banks where you work. So they play this particular role. They accept savings deposits, current deposits, FDs. In those methods, they accept the deposit from the excess unit, and they will route it to the deficit unit in the mode of loans, credit cards, whatnot. Okay, so this channeling happens through the financial intermediaries. over time, there had also been a development. So this particular chain, we call it the indirect financing. Why? Because there's someone in between to coordinate. There's some party in between to indirectly finance. So see, the saver doesn't know that their money has gone to the spender. Okay. Now, if I am putting a savings, some money in my savings account in a bank, so once the bank gets the deposit, they will use it for their lending purposes. So it can be used, the funds that I deposit could have been used to give a loan to a very known blue chip company. But I'm not aware. Okay. What I know is my money is in the savings account. Any moment I can take it out. So I know I'm safe. My money is with the bank. So if I know that it had gone to a loan, or if I had directly given it to a loan, I will be very worried. So as a financial intermediary, that person is managing these two people's interest. Okay. So that's why you call it the indirect finance. So over time, there came a method of directly financing the deficit unit. How? That is through the financial market. So this is where we are going to focus on. Okay. So this is where the financial market fits in. So as a financial market, you look into a more direct source, a direct financing. So examples for how the fund gets channeled through a financial market is when you have IPOs, initial public offerings, our stock market, the debenture market, the debt market. So these can be new terms for you. Don't worry. When we go into the subject, you will understand in detail. I hope that you're aware of about the term shares. So share in a Colombo stock market, if a new company needs any equity, they can get listed and raise capital. So they are the savers, or the people with excess funds can directly come and invest in the company. Okay. So that's how a direct financing happens. So that is method number 2. So first is a indirect financing. Second is the direct financing. Then you have a role where even though the money comes, so the savers put the funds or give the funds to the financial intermediary, and the financial intermediary will then come to the market and invest. Okay, so through this market investment, the funds will then go to the deficit unit. So it's more of a L-shaped. Okay, it moves from lender, the funds come to the intermediary, intermediary gets to the market, and then from the market it goes to the deficit unit. So this third way of channeling, the example is you have primary dealers, you have mutual funds, you have unit trusts who do this. Okay, so let me explain you how they do this. What they do is, as an entity or as a financial intermediary, they will sell. Now, as a unit trust, they will sell units, something similar to a share. So one unit can be 10 rupees. So if you bring 1,000, each about 1 rupee each, I would give you 100. Sorry, one unit 10 rupee each, I will give you 100 units for that 1,000. So you are a 100 units holding unit holder. Then you give me the 1,000. So as a unit trust, I will get the 1,000 rupee. With that 1,000, I will come to the market and I will invest in company shares. I will invest in debentures. Okay. Through that investment will then seep into the company who needs the fund to go and establish a factory or to expand. Okay, so that's how another method of channeling. So there are 3 ways on how this channeling works. Okay. Sorry. So this is the entire fund flow when it comes to a basic or a more on a basic level financial system in terms of a on a more fundamental level to explain it to you. This is how a financial system works. The entire thing is how it rolls out. But you have certain other additions to it as well. Yes, there can be all these happening, but remember, when you make the investment or when your fund flows from a excess unit to a deficit unit, you need to get a return as well, remember. So the return flows in the opposite direction. That's so I have included here the return flow. With the return, remember, you are exposed to the risk as well. So the risk gets also transferred or shared to the excess unit. So how do I explain to you simply? Take the example of investing in a stock or in the share market. You go to the Colombo Stock Exchange. Let's say, X company is issuing shares. One share is 100 rupees, assume. So you give your 100 rupee and buy one share. Okay, so the fund movement has occurred. Now, in that particular year, that company has made good profits. So for one share held, the person is giving 10 rupees as dividends, which is a return to you. You have made an investment of 100 and that person is giving you a return of 10 rupees. So the return comes from the deficit unit to the excess unit. The next year, the company has made a huge loss. Okay. And there is no dividend declared. No dividend declared means you're not getting a return. That also seeps and impacts the excess unit. Why? The excess unit doesn't get any additional funds. That year you get no return. So the risk and the return passes in the opposite, on the opposite direction to the fund flow. Okay. And also remember, this entire setup is always governed by the financial regulation. There is regulation involved in each type of fund flow to ensure that no one is misled, no any mishaps happen in the market. For the efficient functioning of the market, financial regulation occurs. Now you might be wondering, where are the financial instruments in this diagram? Financial instrument is an intangible product. Okay, so if you I know if you put a fixed deposit, you do get a fixed deposit certificate, but when it comes to share and all, you can't show that you have a share. There can be a proof for it, but there is no, you can't show the product itself. That's why you call it a more intangible security. Okay, so this financial instrument is the vehicle which is carrying the fund flow. So for the funds if the fund is moving from the excess unit to the deficit unit, the financial instrument moves from the deficit unit to the surplus unit. So when you invest in a share, the excess unit holder will get the share as the proof. Money will go to the deficit unit. Excess unit will have the share that they hold. Okay, so it's a more intangible aspect, so it's not visible in the diagram. But remember, that also occurs in the opposite direction of the fund flow. All right, so this particular diagram is what a full picture of a financial system looks like. So simply understand it in your head. Financial system is a financial intermediation process, or the main function of channeling the funds from a more excess unit to the deficit unit. That's their main role. How they do it, or what are the components, through what components they do it, is the elaborate version shown here. All right. So here we have the components of financial system. So even in this diagram, you definitely know financial intermediaries is one component. You need to have a financial intermediary in the financial system to ensure that the channeling works properly. Okay. Then you have the financial markets to enable the direct finance. So these two parties make a very big role when it comes to the financial system, but not alone. You also have financial instruments. Remember, for the fund flow to happen, there should be instrument as well. So the instrument is also essential. So that's why you call all these as the primary component. Okay, these you require them for the essential functioning, or for the financial system to be there. These components are a must. Okay. And next you have the financial regulation. Okay, so next you have the financial regulation. So what are the primary components? The four primary: financial intermediaries, financial market, financial regulation. What's not visible here is the financial instrument. So these four have to be there in the financial system. These are the essential or the primary components when it comes to the financial market. There are certain supplementary or supporting components to the financial system as well. Yes, these four are needed for the financial system to work, but if these two are available, the financial system can work smoothly. Okay, they are there to support the financial system. So the channeling happens properly without a delay, safely, to ensure that there is a smooth channeling of flows. You have these two parties. One is financial services. Okay, I will explain that when we talk about that component. And then you have the financial market infrastructure, the online banking platforms, the RTGS, the slips. These are the platform that enable you to transfer of funds or the fund flow. So these two are there to support that channeling of funds. Now, what you might not consciously remember is that these six always work together even to effect one transaction. Okay, so I have given out an example here in this note. So let's take a simple transaction of buying certain shares from a company. Okay, so what is the market? It is the stock market. Okay, so it is through the Colombo Stock Exchange that you will acquire these shares. There will be an intermediary as well, some person to support you to buy. There's some intermediary dealer. So you have the stock broker who will come in and enable you to do this. Now there are now platforms which will enable you to directly transact in the stock market as well. Yes, but a financial intermediary doesn't mean that you only have to come through him. He can even give you some advisors, what stocks to pick, what stocks not to buy. So in that scenario, he might even serve as a financial service provider. All right. What is your financial instrument? Shares that you buy. Who is the regulator? The Securities and Exchange Commission. What are the infrastructures? So for you to make the payment for the investment, you will do some bank transfer. So it can be a slip or a SEFT. For the share movement to get recorded, you have the CDS, your central depository system, where you open an account as a shareholder. So all six of these are working together so that you can do one transaction. Just that one transaction so smoothly, you can see that all six of these have to work together. All right. Now we are going to look into each of these components a more detailed manner. Okay, so we will start from financial intermediaries and then we'll move on to the other components. So I can explain you each of these components in detail and let's see what are their functions, their types and whatnot. Okay. Questions? Okay. So financial intermediaries play a very key or a very main role when it comes to financial markets, as I explained you before. Why they do this financial intermediation as a business? Their business is to channel funds and earn a margin on that. Okay, so they will pool deposits and give out as loan. The deposit rate is lower than the lending rate, so that essentially is their profit margin. Okay, so their role is simply explained in this particular point where I say financial intermediaries perform the role of efficient allocation of funds when there are conditions that make it difficult for lenders, investors of funds to deal directly with the borrower of the funds in financial markets. So when they are unable to work directly in the financial markets, it is the financial intermediary that helps for the different interests to get coordinated. Okay, so let's see what are those different interests as well. So these financial intermediaries, you can break down broadly into two categories. One is the depository institution, one is a non-depository institution. Okay, so depository institution, just as what the name says, these financial intermediaries, they accept deposits. Okay, they accept deposits from individuals, from businesses, and using the deposit they grant loans. So basically, you know the examples of it. You have licensed commercial banks, licensed savings bank, and even finance banks who get the funds in the mode of fixed deposit. So that's also a type of a deposit. So they are also falling into the depository institution criteria. All right. The next one is the opposite role of it, where they don't accept any deposits from their customers. So they deposits are not their method of finding finance, not their mode of sourcing funds. What do? They will either sell securities or obtain contractual savings. So these are the two keywords I want you to note. The sale of financial securities and contractual savings. Depository institution, they accept deposit. It can be current accounts, savings, fixed deposits. So once you get that, they will use those funds to grant loans for each different period. It can be a short-term loan, it can be a term loan for 5 years, 30 years. That's how the banks manage. Deposits are their main source. Okay. A non-depository institution, can they accept deposits? No. But how do they manage? They will either take contractual savings, which I will explain you, or they will have a sale of securities. Through that, earn a commission and use that as their investment. Okay. So based on what method that they use, you have two types of non-depository institutions. So one is contractual savings institution, other one is investment intermediaries. Okay. So contractual institution, now I'm going back to the note. So contractual saving institution, the example that I could easily tell you is, think about EPF, think about an insurance company. On a contractual basis, you need to make some payment to them. Okay. Is it a deposit? No, it's not something that you can withdraw anytime, correct? So it's a contractual obligation that you have to make. It's a contractual saving. From your salary, EPF, ETF gets deducted. That is your contractual saving. You're not willingly making a deposit there, correct? So that contractual saving is used by the pension fund. They will collect them and they can use that contractual savings to make investment. So think about that earlier diagram, okay? So who has the excess fund? Y'all are earning, y'all are getting the salary. So y'all have some, that gross salary is what y'all have, okay? I am a pension fund. So I will collect the contractual savings from y'all, all right? And then I will either go to the share market and invest in shares, go and invest in debentures, and I will route it to the deficit unit. Do you understand it? Okay. Now remember, as a pension fund or as a contractual savings institution, I can't 100% go and put it into deficit unit. There are certain withdrawals. Just like a bank, there can be withdrawals. But for a contractual saving institution, they don't have to worry so much on the withdrawal. Why? Remember, for the bank, especially when you take current accounts, it's on-demand withdrawal. Savings, they can on-demand come and get the money back. Fixed deposits, there is a particular tenor. Okay, but after that tenor, they can jolly well take the money and move out. Okay, but contractual savings institution, think about EPF, you have a certain conditions, you have certain age limits for you to take the money back. Okay, so that institution knows that withdrawals is not so frequent to them. It happens at some particular time. They can easily calculate what the withdrawal can be, the amount. So they know what portion of their amount or what portion of their funding they need to set aside for potential withdrawals and what portion that they can invest. Okay, so they can calculate that. So the portion that they have to invest, they can invest in long term. Okay, think about the EPF itself. Now, I'm assuming you all are young. Assuming you all are less than 35, you all have about a jolly well 20 years or another 25 years to go and encash your EPF. So as a contractual saving institution, that institution can invest long term. They know the withdrawal will come at on a very longer tenor or on a very long term basis. Okay, so they can look into long term securities and invest. I'm just explaining it to you how the contractual saving institution, the mentality of that institution is a bit different. The attitude or the look of the market is a bit different than a bank. All right. Same thing happens to a life insurance company as well. They know on what particular, on a calculated basis, where the withdrawals happen. The funds that they have, the residual funds after allocating for possible withdrawals, they could always invest long term. Even the withdrawal funds that they allocate, they know they can put into some short-term funding, some short-term investment and earn some return out of it. Okay. Investment intermediary. Now this intermediary, how they acquire funds is through the sale of financial instruments and securities. They don't accept deposit. They don't have any contractual savings. Okay. What they would merely do is they will sell the financial instruments and earn a commission. Now think about the brokering firms. Think about mutual funds, the unit trust, certain investment banks. What they do is they will structure or they will create the financial instrument. Now, the deficit unit, they need funds, right? So for them to get funds from a market, they will have to issue a financial instrument. Okay, so let's move to our diagram. So you have the deficit unit here. Deficit unit needs funds. So they have to issue a financial instrument to the surplus unit. Then only the surplus unit will pass the funds to them. Correct? So for them to structure this financial instrument and for them to sell this financial instrument to the excess unit, the investment intermediary will intervene. Okay, they will come and say, look here, we will handle the marketing of this instrument. They will do road shows, they will put up investor presentation, and they will attract investors. For that, they will get a commission. So these parties work like that. Brokering firms, what do? They give advisors. They will say what stocks are being traded today, what is happening in the market. So they will advise the customer to either buy or sell. By buying and even through selling, on both, they get a commission. Unit trust or mutual funds, what do? They will pool funds. Yes, they will pool funds, invest, but they will get a commission or they will have some charge for managing the investment. Investment bank, you will see in all these papers, if you have a look at it, when they issue a debenture, there is a managers to the issue. There are trustees to the issue. Okay, so these people, they will do the marketing or the sale of the financial instrument and collect the excess, collect the commission as their mode of their return or as their source of financing. All right. Microfinance companies, why I have mentioned here is, some microfinance companies are restricted. They are not allowed to take deposits. Still, the Microfinance Act is at a development stage. Yes. So these microfinance companies, their only method now. Microfinance companies, who are they? You need to be knowing about them. They lend to the low income category of the economy. That is the market where banks might be, banks might consider too risky to invest. So that particular sector is handled by the microfinance companies. It can be day wages, where the level of riskiness is very, very high. Microfinance companies will get into, or they will lend to those parties. Now, for them to lend to this high risk segment, sometimes, you can even understand why people might be reluctant to deposit there. Okay, because they are tapping into a very risky market where sometimes there can be defaults coming in. So for them to raise funds, they need to issue or they need to sell financial instrument and collect funds. They can go for bank borrowings, but most of the time, these companies, what do? They will issue commercial papers. They will securitize, something that we are going to learn in this session as well, not in this particular chapter. They will pool their existing receivables and sell it out and collect cash. Okay, that's what you call securitization simply. So in these two methods, they will get the funding needed for their granting of loans. All right. So these are the types of financial intermediaries that are currently available in the market. On a broad level, you can group it into these categories. What are their functions? Okay, so throughout that explanation, I would have explained you or indirectly given out certain functions. So we are going to look into what those functions are in detail. So the very first or the most essential function is they are there to collect funds. from the lenders or investors. But remember, lender and the investor, they are commonly called as the surplus unit. So financial intermediary, the main role or the main function is collect the funds from the surplus unit. What is the next function? Very easy. You lend it to the deficit unit. It can be a lending or it can be a investing. Okay, even banks can invest in debentures. Remember, they have a share portfolio, they have a debenture portfolio, or they can give lending in the form of loans and advances. Okay, so remember this diagram. This tells you the main function. That's obvious, right? Through this diagram, they get the funding. For financial intermediary, the main function is get the funds from the excess units. What's the other role? You pay out or you give the loans or the funding required to the deficit unit. That is their main role. There is another main function that they do. That is asset transformation. Okay. Remember, they are in between here. These two parties have two different intentions, I told you. Now, as a saver, you and I, we save something from our salary. And when we go to the bank and deposit, what are we looking at? We want to ensure that our saving is safe. Okay, we don't want it to, erode away, for the bank to run away with it. We don't want our saving to run away, no? Okay, so safety is a big thing for us. Other one is, we are looking at any time, if there is any emergency, we should be able to take the money out. Okay, so one is, you're more of a very risk averse person. Your asset is the saving. So you don't want to get into any risky ventures. That's why you're putting into a savings account. Okay, if you want more risk, you would have gone and invest in the share market. Simple as that. Okay. Other one is, you need to have a liquidity. Anytime you can take the money out. So those are some of the interest of these people, the savers. Spenders, they need money for long term. They will get into some risky investments. Why? They are the business parties. They can be governments. They have certain policies to achieve. They need to be innovative in the market. So their attitude or their interest is a bit different. Okay. So as an intermediary, what is the financial intermediary's function? They need to match both these two interests. So they need to transform the asset to match the deficit unit's interest. Okay. So let's see how that is being done. So this involves, I think in a note you will have a elaborate of it. Yes. So here, asset transformation, what does it mean? You transform your financial asset where the risky assets are turned into a more safer asset for the investors. So this will involve these three transformations. You will have a maturity intermediation, you have a risk reduction through diversification, and cost reduction. Now, I have certain examples here that you use to explain it. Now, maturity intermediation meaning, remember I told you, as a saver, we put it in a savings account. We look at if there is any emergency, we need to be able to take the money out at any time. That's why you put into a fixed savings, right? If I want, I'll put it in a fixed deposit. If I know I don't need it for a long time. Okay. So if I'm putting into a savings or a current, I need funds any moment, I need to take it out. Okay. So my maturity outlook is short term. Any moment I need to take it out. But the deficit unit might be looking to invest long term. They need to put up a factory. So can you put up a factory in 1 week? Impossible yet. Still, those are the ones that they're looking at. They need funds for a long-term venture. As a bank, what do they do as an intermediary? they accept these savings. Yes, you bring in the deposits to us in the mode of finance savings account. We don't mind. So they pool these funds and they lend it out to the deficit holder for their long-term investments or the long-term requirement, long-term loans and advances. So any moment a withdrawal comes in, they know the amount in circulation. They have a portion allocated for that. The other portion, there can be certain savers who hardly withdraw, who don't withdraw the entire amount. So those amounts they can easily lend out. So there you have a maturity intermediation. Okay. And another one is a asset. Simply, if I'm telling you what an asset transformation is, you have savings account is your asset. For you, it's the safer asset. Okay. For you to go and lend it to a company to put up a factory can be risky. But if the factory doesn't work out, what if you don't get the money back? It can be risky. So you look for a safer asset like a finance saving deposit. Okay. What does the bank do? This risky asset, the loan, they convert it into a very safer asset, something like a saving deposit. Look here, you put 1,000 each month, or you put a small amount here as your savings account, and they will transform that safer asset of yours to a risky asset, or to maybe a long-term asset that you might not be interested in investing directly. Okay, so that example is here. The saving asset held by one person can provide the funds that enable the bank to grant a housing loan to another person. Housing loan, 25, 30 years it will go. Okay, so what have the bank done? They have transformed that safer asset, that your asset, into a more risky or a very long-term asset, a housing loan. So these kind of interest transformation is also done by the bank. So that is one of their major functions after pooling funds from the surplus units and lending. For these two to happen, the asset transformation has to occur. All right. So remember the first three functions. I am explaining the functions of a depository institution. Okay, if I'm directly linking to the types, in these three, I am talking about the function of a depository institution, mainly. All right. So these three are the one that they would essentially do as their business. After that, what you have from the 4th to the 8th, it's more coming to the non-depository institution. So these are the functions that done particularly can be done by the non-depository institution. So let's see what they do. You have facilitating trading of financial assets through customers through brokering arrangements. So remember, investment intermediaries, they will act as a broker, enable you to sell the financial asset and route the funds towards the deficit unit. The other one, it can be a new concept to you. It's called margin trading. Okay, financial intermediaries also do this as a function. What is that is, they will facilitate trading of financial asset by using the intermediary's own funds. Okay, so that the party buying or the surplus unit holder can take a position in the market. Let me explain. Now let's say you're going to invest in the stock market. You have 50,000 rupees with you. All right. With 50,000 rupees, I am the stock broker. You come to me. I will open up a CDS account for you for trading. And then I will advise you. I will say, look here, currently these stocks are going very catching up at the moment. So if you know the stock market currently the banks are being undervalued. Why now? You know, during the COVID period, how many moratoriums you would have handled during this time. So because of this moratorium, the bank's share prices have got a hit and the bank share prices have come down. Okay. So as a stockbroker, I might recommend you, I would say, look here, if you want to put your funds for a long term, very big profit, I would suggest invest in bank shares. It's undervalued. So why don't you invest in some bank shares? So your 50,000, you will invest in some bank shares. Sometimes, now it's only 50,000, right? You might have not enough funds to invest in another bank share. As a stockbroker, I will say, don't worry, you have 50,000. I will give you additional 10,000. You use that and invest in the share. Now, do you understand what's happening? I am allowing you to take a position in a financial asset. I'm allowing you to buy a financial asset with my own funds. You will be wondering, why am I doing that? That's because I can charge interest from you as well. Okay, so as a stockbroker for margin trading, there's a certain interest charged as well if you don't pay back. Okay, and it's safe because your portfolio will be the security of the stockbroker. So the financial intermediaries are well secured when they design products. Okay, so margin trading is that they will let you use their own funds for you to take a position in a financial asset. So that is what you call as a margin trading. Other one is assisting in the creation of financial assets for its customers, and then either distributing those financial assets. Sorry, I think you have to delete this, strike this through, and then distributing those financial assets to other market participants. Examples, commercial papers and securitization. What I'm referring to here is investment intermediaries. Remember, I told you, they will come in. Now, when a deficit unit needs some funding, let's assume they need to put up a factory. As a financial intermediary, or specifically as an investment intermediary, I will come in. I will advise the company, okay, why don't we go for a stock issue or a commercial paper issue or a securitization. I will advise them. Okay. So if it's a share issue, I can basically handle the share issue, nothing for me to create. I will handle the share issue and get them funds. But when it comes to commercial papers, securitization, we will have to look into. Commercial papers is relatively easy. Securitization specifically, you need to look at their loan receivables, or the receivables of that deficit unit, collect them. There's a structuring of the financial assets. That's why you call it a creation. You will have to create that product. And can you just create and let it go? No. You have to go to the market. You have to market that product to the investors. You will say, look here, this financial product instrument is there. This is the return of it. Why don't you invest? These are the benefits. So that particular role is done by the financial intermediary as well. More specifically, done by the investment intermediary. Okay. So that's why we are referring to this as assist in creating the financial asset. So they will structure that entire deal for you, structure that entire financial asset for you, where they will help you decide, we can price it at this point, we'll put this as the return percentage, we will have a return of this much, we will have a tenor of this much for the product. So the investment intermediary will advise the deficit unit and create that asset for you. And after creating, they will take that asset and market it. They will ensure that the purchase is done, the investment is done, or the sale of that instrument is done. so that the funds are collected. Okay. Seventh, that is providing investment advice to customers. That is very simple. I hope that you all can understand that this particular role, not only by non-contractual, non-depository institutions, even depository institutions do them. Even as a banker, if you're working in a branch, you might have certain customers coming to you saying, look here, this is my requirement. I need to expand my business. What is your advice? Should I take a loan now? Should I wait? Should I go have a initial public offering? So those kind of advice, they come to you. So that is one of the reasons why this subject is important to you. Why? You need to be aware on what's happening in the market to give advice to your customers. Okay, now with the interest rates coming down so less, we are at a single digit interest rate at the moment. A more of a debt funding is encouraged. Why they have a single digit interest rate at the moment? They want to boost consumption. They need to boost investment in the country. So you will borrow and invest in productive investments. Okay, not non-productive. It has to be productive. You need to have some goods and services coming out from your investment. Okay, so as an advisor, you need to be aware to do this role properly. So that's one of the benefits of this subject. So you'll be aware on what's happening in the market. Okay, remember that's also one of your functions, irrespective of whether you're a depository or a non-depository institution. Okay. Last is manage the financial assets of customers. Okay, you need to manage the financial asset. Now, this is more relevant to investment intermediary. Remember mutual funds. Okay, so there can be certain private portfolios handle. Private portfolios meaning if there is a person, a high net worth individual, let's say certain director of a company who has about 100 million excess funds. Okay, so if they have such an amount, you can ask them, look here, why don't you give me that 100 million? I will manage it for you and I will give you an annual return of this much. Okay, so that person will give you the 100 million where you will invest in stocks and debentures and you will ensure that the asset grows for the customer. So asset management. Okay, that's also done in Sri Lanka, not very popularly known, but a lot of high net worth individual outsource their investment to certain institutions, certain investment institution. So it's a private portfolio. So that particular person's portfolio is handled by that company. So they will do work to the benefit of the customer. Yes, they will get a commission, but their function is manage that financial portfolio and grow it. That's their main role. Okay, that is also now currently done by certain banks investment units. They also look into the managing of financial asset. Remember, this doesn't only apply to high net worth individual. Even on a branch level, you and I can be doing this. Why? This is this is a more of a coupled function with investment advice. Okay. Now, if you have certain savings, being done regularly by a customer with very less withdrawals, let's say certain current account, you have a huge bulk and idle of funds. Sometimes you might say, okay, why do you have such funds being idle? Why don't you invest in this product? Why? So certain advisors, and you will help them to manage their asset with that advice. Okay, so these 8 are the main functions when it comes to financial intermediaries. Next, we move to financial instruments. Now, financial instruments, remember, we use the word intangible These are intangible assets that are expected to provide you future benefits in the form of a claim to future cash. Simply think about a fixed deposit. Okay, fixed deposit. The proof is you have a fixed deposit certificate. Yes. So what does that give you? It gives you a future benefit. Now, if I deposited money in a fixed deposit today, I get my certificate. I know in 3 months' time, I will get a interest of this much. So I have a future benefit in the form of a claim to future cash. Okay, do you understand? So that is a simple definition when it comes to financial instruments. Take a share in the stock market. You invest in a share. What does it give you? In the future, when the company is performing well and when they declare dividends, or when the share price of the company grows, you have claim on that future cash. Okay, simple as that. Always remember, when it comes to financial instrument, a creation of a financial instrument, there can be several parties involved. But fundamentally, there is always two parties when it comes to financial instrument. One is the issuer, other one is the investor. These two parties are always there. These are the minimum two parties. There can be one party. Okay, these two are always there. There can be certain additional parties involved, certain managers to the issue, structuring party, yes, but these two are the essential two people involved. So issuer, what do they do? Issuer is the party who will issue the financial instrument and collect the cash. Does it stop there? No. They collect the cash, yes, and they agree to pay the future cash repayment. Okay. Think about fixed deposits again. As a bank, I am the issuer. I will issue the fixed deposit certificate. Okay. And I will collect the deposit. What is my agreement? In the future, in 3 months' time, if you come back, I will give you your deposit and this amount as the interest. Okay. So as an issuer, these three is what you do. What does the investor do? Investor owns the financial instrument, gives the money to the issuer, and gets the right to receive future payments. Okay, so if I have to highlight the essential words here, remember, issuer issues the financial instrument and agrees to make the future cash payment. Investor owns the financial instrument in return for the money that they give. Okay, and therefore I'm unable to edit it here. I don't know why. And they get the right to receive payments. If you can mention it here as right to receive the future payments. So they have the right to receive it until they hold the financial instrument. Okay, till they hold the financial instrument, they have the right to claim the future payments of this. Another example I could explain is, again, take the shares. Share is issued by the issuer, a company. Let's draw it up here so it's easier for you. So you have a company. This company is the issuer. Okay. What do they issue? They issue shares. Okay. On the other side, you have the investor. So let's say it as X. What do? They own the fund. Now, they own the instrument. Now, this shares, let me get the R right. If not, it looks like shaves. So, this share is now owned by X. What does X do? X has to give the money to the company, funds. Okay. Now, what is the agreement? Agreement of the company is indirect agreement here is, look here, if I'm making a profit, I will pay dividends. Okay. What about X? What is their right? Their right is the right to this particular company's future profit. So they have the right on the profit in the form of future dividends. I hope it's clear for you. It works for a share, and even on a deposit angle, I explained it to you. The driving force behind financial markets is the desire of investors to earn a return on their financial instruments. This return has two distinct components. Okay, when you talk about return, it has two particular components. One is the yield, other one is capital gains. Now, always a lot of students confuse this term called yield. I don't know why. When they hear the term, they think they get confused. Simply understand yield as this. Yield is an income that you're getting when you own that asset. Until you own it, you get this return. That means that's a yield for you. Okay. Capital gains happens when you sell it. Okay. So it's not called yield. That's why it's called capital gain. When you sell it, when you disown the investment, you get this particular return. And that is called capital gain. So simply, if I have to tell you, let's say you own a particular asset, you invest today until end of December. Okay, today till 1st January, let's say 2nd January 2021. Okay, so if you invest today and hold it, invest, sell. Okay, so during this particular period, when you own the financial instrument, any income that you get is called the yield. From that instrument, this is the return that you're getting when you own it. But when you sell the asset on this particular date, you get the capital gain on selling it. If your selling price is higher than the buying price, There you get your capital gain. Okay. Throughout the period of the asset, what you earn is called the yield. I hope it's clear for you. Understand that in your head. Okay. Yield means the income that you get from the asset when you hold that asset. Okay. So ideally, when if you take stocks, you have dividends. Okay. So till you own it, that's what you get. Okay. When you sell it off at the end, you will get a capital gain. All right. Now, why I have put here on the second is on the first of every year, the market is closed. So ideally, I'm being realistic in my example. Okay. So on the 2nd of January, the sale happens is what I assume here. The investors' preference vary as to which type of return they prefer. Okay. And these preferences in turn will affect their investment decision. Okay. If as an investor, you're looking for yield, you will continue to hold that investment. More of a long-term investment strategy. Am I correct? Capital gains is what are you going to do there? Increase in the value of the investment. You buy at a low value, sell at a higher value, and get that return. So you will look into a more of a trading strategy, a very short-term strategy. Okay, you're not focused on the yield. You're not focused on the dividends that the share issue. No, you just want to buy today at a low price, sell tomorrow at a high price, and get your capital yield. Okay, sorry, you get your capital gain. On a yield perspective, you're looking to hold that asset for a long time, and while owning, you will try to get higher dividends. Now, in the stock market, if you take certain stocks are there, you call them the dividend stocks because these shares give a very good return to you in the form of dividends. So, if you are looking for a more long term and a more safer investment, you will invest in those particular stocks which gives you a higher dividend. Okay, so this strategy depends on what return you prefer, whether it's yield or capital gain. All right. As a financial instrument, it does two functions, and we know that. One is it allows the movement of funds. It's the vehicle which carries the fund. And on the other angle, it helps to redistribute the risk. Okay, remember when the financial instrument movement occurs, fund goes from the surplus unit here, fund moves from the surplus unit to the deficit unit, and the risk and the return also comes on the opposite angles. For this movement to occur, the financial instrument is what is moving. So fund movement happens and the instrument moves in the opposite direction, redistributing the risk to the other parties. All right. Then we move to financial regulation. Financial regulation, as I told you, it's a primary component when it comes to financial system. Why do we need regulation? You have three reasons for that. These can be used as reasons for regulation or as objectives of the regulation. One is simply ensure fair treatment to market participants. So that if you have financial regulation, every participant is treated in the same footing. One party is not preferred over the other. Okay, so ensure that the information also goes into the on a same level. So here I'm talking about a more insider trading scenario. So to avoid those and ensure fair treatment happens, you need regulations to come in. Why? If you don't have regulation, I might have certain information that you don't have. Okay, so that information gives me a better chance to get a higher profit. Is it fair? No. So to ensure that the on equal footing all market participants are treated, you need regulations to step in. Other one is to ensure accurate information is given to all market participants. Here, remember, keyword is fair treatment. Here, you are looking at accurate information. There can be fair treatment to all market participants. But what if the accurate information is not given out? What if a false information is given out? Okay, so here we look into that. Okay, here also we look into insider trading. Why? Sometimes it can be disseminated. The accurate information can be only given to certain parties and the other party is not aware of it at all. Okay, so to avoid these two scenarios, again, financial regulation has to step in. And the other objective is on a more broader level to ensure that the financial system is on a very strong, doesn't get impacted by any crises, doesn't disrupt easily. You need certain financial measures and regulations to come in. Think about the banks, why they have certain capital adequacy ratio, minimum capital. Why? They want to make the banking system stronger for them to face any shock in the market. So to improve and strengthen the financial system, you need the financial regulation to step in. Okay. So these are some of the notable financial regulations that have come in that has affected the entire financial market on a global scale. Okay, the very first one is the Sarbanes-Oxley Act coming in 2002 in US. After the dot-com bust and the Enron bankruptcy, the Sarbanes and Oxley Act came in and it was a big milestone when it comes to corporate governance. Okay, so this, I don't know why the read mode gets impacted. Okay. Okay, so this plays an essential, or this was a more of a major transformation in the regulatory platform, on a regulatory environment when it comes to financial markets. Next, what we saw was the US Wall Street Reform and the Consumer Protection Act that came in 2010 after the global financial crisis. Simply they call it the Dodd-Frank Act. Okay, so there they were imposing, so there they looked at more tighter regulations for financial markets and the intermediaries, so the consumer is protected, so the investor is protected. All right, next we saw, and this was one of the biggest development that we so far even being implemented at the moment, the Basel III for the banks especially. So here you look into improve the capital standards. Not only the you don't look at the quantity of the equity as well. Now remember, when there is a shock to the banking industry, the bank should have adequate capital to face that shock. All right, so Basel II address the issue of having adequate capital, but was the capital available of a good quality? That quality was not addressed when it comes to Basel II. So that's why in Basel III, you have on a staggered basis certain ratios coming in. Okay, so that not only the quantity, even the quality of the capital is addressed. That's why you need to have a tier 1 capital as a certain percentage. So tier 1, tier 2 is addressed specifically for these purposes. Okay, so there, what you're trying to do, you're trying to strengthen the financial system, or more specifically the banking sector, so that it can withstand any liquidity shock or any particular crisis that can hit the market, so that a contagion scenario doesn't happen like what happened in the global financial crisis. Okay. Then we have financial service providers. Now there I showed you, even in the syllabus, we have a separate chapter to go in detail for this. Okay. So let me first tell you on here, I will briefly tell you on who the service providers are, but we will study them in detail in that particular chapter. So you have brokers and dealers. Those two, you might assume that they do the same function, but no, they do a different function. Brokers do on a, their business is to make sure that the buyer and the seller is met. Dealer will do on their own account. Dealer will buy and dealer will sell. So there are certain differences. We will study that when we move to that particular chapter. So you have research and dealers who are service providers in the market. You have research companies. What are these research companies? These companies research on the listed companies in our stock exchange. You know, in our stock exchange, when a company gets listed, all their information is publicly available. Let me try to show it to you. Here you can see, let's go to a renowned company. So here you can see the last traded price, all the stock related information and the company related information, when it was found, what is the listed date, who are the board members, the key executives, the financials, the announcements, everything is available. So using these information, the research companies will study about the current position of the company, and they will give some forecast to the future. Look here, this company is currently trading at 150. In the future, this company is capable enough to go to 170 or 180. So that kind of a prediction can be done by them. That's why those research companies are there. They could recommend certain stocks. They could say, no, this is the time for you to get out of the stock, sell this particular share. They might tell you, look here, no, you hold this stock. It can move up, and at that moving up stage, you can sell off. So the research company also does a supporting, how does it support the market? Through market advisors, okay, and more market insights. Then you have rating agencies. I hope you are going through the market happening so far, so you know Sri Lanka got downgraded. So Fitch is a rating agency. What this rating agency does is it provides a service to the market where through their rating they signal information. Look here, risk of this particular company, risk of this particular country increased, decreased. These are the reasons, these are the factors which cause this improvement or cause this decrease in the rating. So here you can see key rating drivers. So there they will justify. due to these reasons, the risk was so high, we had to downgrade the company. Okay, so certain factors they can also mention as, look here, if this happens, rating can get improved. The risk of this particular company can come down. Okay, so those are also mentioned by the rating agency. So all these will help the market, will help an investor. If you are looking to invest in a company, if you are looking to invest in a country, that will help you to analyze whether this country is a sustainable one, whether this company is a sustainable one, whether we can get in, whether we could invest and lend to this particular company. That information is given out by rating agencies. So locally, we don't only have Fitch, we also have ICRA. If you have time, check on their websites. I know you might not, but that's why I'm showing these to you now itself. So this is ICRA. You can see ICRA, the rating that they've done and the latest ratings is shown here. If you click on a particular company there, you can see the detailed write-up for the company, and you can download easily the rating report. You can read the rating report. The company, the rating agency justifies why they gave that rating. Okay, or why this rating can be sustainable, or why this rating can change in the future. So all these areas they can cover. Then you have credit bureaus, which is our CRIB, for example, where you get all the information about the lenders. Locally, we call it the Credit Information Bureau. That is also a service provider, especially to us bankers. If you're considering a loan, it's essential that you check on the CRIB, see their past repayment to see the character of the borrower, whether the borrower is a habitual defaulter, occasional defaulter, or as a more regular or a more genuine customer. All right. Then you also have information providers in the form of Bloomberg and Reuters. These are, each bank, your treasury has access to these two terminals where they get the information firsthand on exchange rate, the market developments and whatnot. So they will easily pass out market information faster to the market intermediaries. And then you have press and the media. They also do a service to the market. Why? They give development that happens in the financial market to the other investors, so they're aware of what's happening locally and even internationally. So locally also we have some good media that address these. As I told you before, I suggest you to look into them. I know even though I say for you to have a look at it now, you might not look at it now. But even if you're having closer to the exam, visit them. They have their sections staggered wise for you. So if you are interested in particular sector, you can click on that particular sector and go get all the information. So if you go to banking, you get the latest banking sector information there. So you're updated. You're aware of what's happening in the market. Okay. Then you have financial market infrastructure. So remember these two parties, the financial service providers and the financial market infrastructure. These two are supporting entities. They are there to support the smooth functioning of the financial system. So you saw how these parties give information, give updates of what's happening in the market, and allow the investors, the deficit unit and even the surplus unit to be aware on what's happening in the market. Okay, they are informed. That's their service. That's how they help the financial system. Financial market infrastructure is the platform that allows you to do these fund transfers, the security financial instrument transfers, to be done smoothly. So let's see what that is. FMI is the multilateral system among the participating financial institution, including the operator itself, and you use it to record, clear, settle payments, securities, derivatives, and other financial transactions. Now, I don't want you to memorize this definition. Understand what it means. Understand that financial market infrastructure, multilateral system. That means all the participating financial institutions are involved. They have access to it. Think about slips, think about RTGS. All the banks have access to do fund transfers through that mechanism. And central bank, which is central bank has certain institution, Lanka Settle, Lanka Clear, which is the operator of the system, also has access to it. So that's why you call it a multilateral system, where the participating institution and even the operator itself has access. And this system is used to record a transaction, to clear the transactions, the transaction occurs, to settle any payments, to net off any payments, and to transfer any securities, derivatives, or any other financial transactions. Okay. What is the main intention of a financial market infrastructure? Let's say you go to a particular bank. Okay. So in this particular bank, they have their online banking facility. So this is part of their platform or their access to the infrastructure. Okay. So let's say, so when you access it, it lets you get into your account and you can do fund transfers and everything. Now, when I get into this website, this login, and I get in, what is my intention? I want to make sure that let's assume I want to transfer some funds from myself to one of you. Okay. If I'm transferring, I want to ensure that the fund transfer happens safely. My information doesn't get leaked out. The money does arrive to you exactly, my intended party, so it doesn't go to someone else. Okay. So safety is the biggest concern when it comes to these infrastructure, so that someone doesn't hack it, someone doesn't filter my essential information, my password and everything, my account number to another website, to another person. So safety is important. What if the particular platform has all the safety in the world? It is the safest platform. Okay. But if I do a transaction, it takes 1 hour for the transaction to happen. Okay. If this is I'm giving you a platform, that platform is the safest platform. But if you do a transaction, it will take you 1 hour to do the transaction and another 1 hour for the money to go. Okay. Or yes, safest infrastructure, but if I do one transaction, that happens very quickly. Another transaction takes me half an hour. Another transaction takes days for it to go. What am I missing out there? Even though it is safe, it is not efficient. It doesn't do at the correct timing, and the service is not consistent. Each time it's a different service experience. So the efficiency is also destroyed. So even on an operator or a regulator or the participating financial institution like a bank, their major objective is to ensure safety. That's the first. And then efficiency. Both has to be there. You can't just have one and not the other. So what does safety mean for you? there can be certain risks that you're exposed to by doing these transactions through this infrastructure. So first, how do you manage this risk? First, you need to identify the type of the risk must be identified. Okay. And then you determine the sources of it. Once you know the type of the risk and once you know how this risk can happen, what are you going to do? You will now you know, okay, this is the risk. This can happen through this way. Now I will take the essential steps to monitor whether that risk is happening, and if that risk happens, how can I stop it, or how can I prevent that risk from happening at all? That's what I look at next. Okay. So appropriate and effective mechanisms to monitor them and also to manage them. Now, this can be technological risk, legal, liquidity, or even operational. You need to study the system. You have to see from what sides that risk can come in, from what source is it coming, and then what steps for you to curtail it. And you have to continuously monitor it. Just because you took the action, you can't stop it from there. You have to monitor. That's how you ensure the safety of a financial market infrastructure. What's the other one? Efficiency. Remember here, not only timely, but it also has to be consistent. Okay. For you to do your transaction properly, both these components has to be available. If this is not there, even though it's safe, your connectivity, your ease of transaction is not going to be delivered to the market. All right. So if there is an inefficient point, that itself is another risk for you. Okay. What are the main types? So these are the main types of financial market infrastructure that we have in the moment in Sri Lanka. You have the check imaging and the truncation system, which is operated by the Lanka Clear, so that it enables you to clear the interbank checks on a T1 basis. So if you deposit the check today, it will get cleared by tomorrow, subject to availability of funds in the account. If it's an in-house check, it can get cleared on that day itself. In-house meaning, if you're working for HNB and one of your customers deposits a HNB check, that is an in-house check that can get cleared on the trading day itself or the T date itself on the very same day. If you are at HNB and one of your customers deposits a People's Bank check, what happens? It takes an additional 1 day for clearing. Or not only People's Bank, it can be any other bank. If it's an interbank check, it takes a T1 basis to get cleared. This is the most efficient that we have come as of now. Earlier, it was 5 to 6 days for such clearing to happen. Remember why this is a benefit to the market? Earlier, it was 6 days for money to get credited. So much can happen during that 5 to 6 days. But now the very next day you get. So the trade is supported, very quick money transition, and it's more safer for the parties to engage. Then you have SLIPS, the Sri Lanka Interbank Payment System, that is also operated by Lanka Clear. It is an online interbank fund transfer system, but the limit is up to 5 million. Remember, this is not a real-time platform. We have certain cutoff. In that particular cutoff, the payment has to be done. If you make the cutoff in the morning and even by 12:30, you can get the other party, your beneficiary can get the funds within the day. If you do it in the latter part, I think it's the 3 o'clock or the 3:30 cutoff, the funds will come in the very next day. Okay. The other development that we have as of now is the CEFT, Common Electronic Fund Transfer Switch. Now this is a online but real time as well. What do you mean real time? If I make a fund transfer from my account to you through a CEFT, you will immediately get the money. My beneficiary will immediately get the funds. It's real time. Okay, and you can be done at any time of the day. There is no restriction that the bank has to be open for this to be done. Okay, now slips, it has to go through the bank. Now I think you can even do it on your mobiles as well, but CEFT is what that is commonly preferred by everyone. Okay, then you have the real-time gross settlement system, which is for larger than 5 million ticket sizes. That's how you do your transactions. And then you have the scriptless security system, where you record and monitor the government securities, and these two are operated through the Lanka Settle by the central bank. Lanka Settle is the entity which manages these two platforms. Okay. Now we move to our main topic. So now we have covered, if you look into our components, we have covered, except for financial markets, we have covered all these three. So now we are aware about all the other five. Now we look into our financial markets. You know what a market is, right? Market is a setup, not a physical space, essentially any setup where two or more parties engage. Now there, one party sells and another party buys. Okay, there is an exchange that happens. Okay, so the seller sells the goods to the buyer, buyer will get the goods, money will move from the buyer to the seller. Just like that, in a financial market, what happens? Seller, who is the issuer, will issue financial instruments. Investor will own the financial instrument and give out the funds. Okay. So financial market is where the financial instruments are exchanged or traded. So these financial markets facilitate the flow of funds. Remember our diagram, a direct finance is allowed. Financial market, therefore, can be a market for credit where there is debt sources, or it's a market for capital where you can raise funds through equity. Okay, so financial market is the market for credit and even equity, and this is one of the crucial components of the financial system. So what are the functions when it comes to financial markets? Let's go to the note. I've been elaborate there. So what do these markets do essentially? The very first or the primary function when it comes to a financial market is liquidity. Okay, what do you refer to as liquidity? Liquidity is the ability for you to sell something quickly and at the market value. Understand the two keywords there. It has to be, it can be a sale or even, let's say, exchange of an asset. It has to happen at the fair market value and at any time. Time is not a factor. Okay, time shouldn't be a constraint for you. Let's assume this is a bottle that I need to sell in the market. I know the actual price of it is 35. I should be able to sell it in the market at 35 at any given time. Okay, that means the market is liquid. What if I go to a market and that market doesn't have much buyers for this? If there are less buyers and only few buyers, that buyer will say, no, look here, let's say only one buyer is available. Look here, I'm the only one to buy. You give me at 20 rupees. So not a fair market value. It has a very lower value than that. And if I don't have enough buyers, can I go at any time and sell it? No. I have to wait till a buyer comes in for me to sell it. Get it? So liquidity gets impacted. So liquidity is a main factor when it comes to financial markets. Financial markets, what do? They allow the buyer and the seller to meet. So there can be several buyers and several sellers. Okay. So that itself gives you the liquidity for an asset. Okay. It gives the investor to trade easily. If you don't have liquidity, you're forced to sell at a lower price than the market value or wait till a proper buyer comes. Let's say you invest in a share. Okay, X company, you bought that X company for X company's one share at 100 rupees. Okay, now you want 100 rupees immediately. You need to sell that share and get that 100 rupees to immediately. Now, if you invest in a company's share, that will remain until that company goes into liquidity. That money will not come to you. It's equity, right? So, can you wait till that company wind up for you to get your money back? No. If you have a stock market, what happens? Yes, now you can go to the stock market, easily sell your one share and get your money back. Okay. If you have that financial market, it's easy for you. It gives you the liquidity to sell your 100 rupee share easily. Let's say you don't have a market as such, you have to hold it till a buyer comes. And even if a buyer comes, that buyer will say, look here, not many are there to buy. Only I am there. I can't give you 100. Let's go. It has to be lesser than that. Okay. So liquidity will get impacted. So with the presence of financial markets, investor can trade within themselves, between the investors, without holding that instrument until maturity, until its end of time. They can easily trade it. Every financial market has some level of liquidity. Okay, certain markets are very liquid, certain markets are not. Sometimes even within a market, certain assets have high liquidity, certain assets have low liquidity. Now, if I am explaining it to you clearly, if you go to our stock exchange, you have several companies which are listed. Let's say company data. So these are the companies which are listed. Okay, all these companies. Now certain shares, certain company shares will have high number of buyers and sellers, and certain shares will have very low level of buyers and sellers. Now if you see here, see this particular share has got traded. Only 25 shares have got traded, but these shares have got traded highly. Certain shares not traded at all. So that shows you the level of liquidity for that share. Okay, so whether you can get out of that stock easily, whether you can buy it easily or not. Okay, so liquidity depends on the market and depends on the financial asset as well. Next, you have price discovery. Price discovery meaning it helps you to identify the price of that particular asset. What is the market willing to pay for that particular financial instrument? Okay, so the market, because it's available and so many buyers or sellers are there, you know the price clearly. But if you don't have a market, you don't know the ongoing market price of that particular product. So a financial market enables you to discover the price of financial instruments. Okay, and while you discover the price, that allows you to value that asset. Now if you know the price of this as 35 in the market, you can easily value 100 bottles like this. So just like that, if you know one share, price of one share, you can easily value that entire company. If one equity share is at this price, what is the value of this entire company? So your asset valuation is also supported. I think we have to wind up, and then we'll, now next class, let's start off from this point. We have only a few slides to get in. And after we finish it off, we will move into our second chapter next week, classification of financial markets. Okay, so with that, we'll wind up for today from this point onwards, and we'll start off from that. Okay, thank you so much for listening. If you have anything, if you have any doubts, let me know. So we'll meet next week. Okay, thank you.